Okay, we're back with Dr. Richard Smith, the CEO for the Foundation of the Study of Cycles. So what about investing in exposure to blockchain? What types of stocks would you recommend to get some exposure without investing in Bitcoin specifically, without giving buy or sell recommendations?
I mean, I'm personally a fan of Coinbase, and I think that it's a on-ramp to the blockchain crypto world that is an incredible brand that has unbelievable goodwill at this point and has 56 million customers, which is just astonishing. So I think that Coinbase is really well positioned to be the Apple and or the Tesla of the crypto blockchain world. And I think that they're going to be a big influence in that world going forward. Now, I'm not a buyer of Coinbase at these levels. I did try to get in at what I thought was a fair price in the IPO, but it opened way above what I was willing to pay for it. So
now, as it relates to Coinbase,
interesting.
I think the risk of Coinbase, though, is a Vanguard or a Fidelity gets into it, charges a fraction of what Coinbase charges, and then puts them out of business. So, what about that?
I think that they absolutely have pressure coming on their transaction margins, but I think that when you have 56 million users who see you as the on-ramp to this world and somebody who's managed kind of the to balance, I guess, the tension between kind of the anarcho-capitalist tendencies of Bitcoin and blockchain and the more publicly digestible aspects of crypto and blockchain. I think that's a lot of branding power, and branding power really matters in the world today, in our world today, in our attention economy. So I wouldn't undersell Coinbase. I think they're going to be hard to unseat, and it's not going to be as simple as just offering lower prices. I think they're going to be able to diversify their revenue stream fairly quickly, and they're going to be a formidable player for a long time to come.
What other players do you like in the Bitcoin space? Like some say the Cash App, PayPal, Square.
There's certainly Square and PayPal and MicroStrategies with Michael Saylor. I think they're all doing interesting stuff. But in terms of a brand that can really be one of the leading lights in the crypto blockchain space, I don't see any other real viable candidates besides Coinbase right now that is available to the public.
No, wonderful. Well, thank you so much. This has been good. What about you're kind of noted in some of your work for the proper way to put a stop in on a stock. And I think your methods became so famous that I would argue, I don't know if you've ever heard this, but it sort of triggers all these systems. And I saw it in March. I don't know if you saw this, March of last year. Once everything hit like a 20% trailing stop, everybody started selling. Mm-hmm. And the reason I picked the bottom very, unofficially, but among our groups, I saw that we hit bottom in late March of last year, because my theory was, the reason why we had this sharp 40% drop is you had all these computers telling their algorithms or whatever to sell. They sold, and then we kind of had this washing effect around March 23rd, 24th, and then there were no more sellers left. Has your formula become so mainstream it's not a good one anymore? No offense. And first, tell people your kind of general formula first, because they may not even know what I'm talking about. So,
well, this is the first time I've ever been credited with possibly contributing to a major market crash. So, thanks for that, Josh. Look, the basic thing is that most people, and this is Nobel Prize winning economic research, most people are risk seeking when they're losing and risk averse when they're winning. What does that mean? First of all, Daniel Kahneman in 2002, Richard Thaler in 2017 got Nobel Prizes in economics for pointing out that we hate to lose, which sounds kind of silly. So true that it's just a truism, but the fact that we hate to lose has different consequences for our decision making depending on if we're underwater on an investment or if we're winning on an investment. When we are losing on an investment, we don't want to sell because we hate to lose, and that means selling equals loss in our minds. So we take more risk. We double down, we triple down, we turn a short-term trade into a long-term investment. But then when we're up on an investment, the fact that we hate to lose attaches itself to our profits, and we become risk averse and get nervous about staying in the markets. Excuse me. So we're risk seeking when we're losing, we're risk averse when we're winning. Meanwhile, markets regularly do things that totally defy logic. So psychologically, we have a mechanism for getting destroyed by the market madness and not really having our profits defy our wildest expectations. So that's the genesis of why even a simple trailing stop is a very...
So we'll talk about that. We got to take our final break of the hour. Trailing stop, what's the appropriate amount? And did Dr. Richard Smith break the market in March? When we return, this is Josh Jalinski, the financial quarterback. Don't touch that dial. So we're back. This is Josh Jalinski, the financial quarterback. And I don't mean to credit you with the market crash of March 2020. But what I mean is so much of the market is now traded on computers that I think a lot of these people are familiar with your work on trailing stops. And they put in, a 10% trailing stop or a 20% trailing stop because you've done some definitive work on that. So I feel that when we hit that place in March, all the computers were going off with sell orders. And then sort of you give it a week or two and it kind of stabilized. There were no more sellers left. So then the market rebounded. Yep. And that's what I meant. I think your work has become mainstream, which may be a bad thing because it may. So have you ever thought about that?
I have thought about that. And look, anything that is novel in markets, and I first launched my site to track trailing stops back in 2005. So that was quite a while ago now. And anything that works will be adopted by more people, and then it'll stop working. So there's always that risk. We always have to be attentive to what's going on in markets. And certainly markets have been driven by algorithms and computers more and more. I don't think I am the only one doing that work by any stretch. I think that I brought it to the public's attention, but plenty of smart people have figured it out along with, or even before me. Cliff Asness over at Advanced Quantitative Research, kind of the father of momentum-based investing, is one of the prominent guys who really made a lot of these initial discoveries and whom my work was inspired by him. So yes, we always have to be vigilant to make sure that what has worked in the past will keep working in the future. But for me, Josh, it's always really been about human behavior more than the algorithms. And as human beings in the markets, we have to find a way of making sure that we're not risk seeking when we're losing. We're not doubling down on our winners. We're not on our losers, right? We're not letting our losers get away from us. And we start letting our winners get away from us. And that really is what your work is about. What you were talking about, blocking and tackling, you got to do the basics.
So you're still an advocate. So you're still an advocate, excuse me to interrupt, still an advocate of the 20% trailing stop as a general method of risk management.
I think if you don't have anything else, that's a great place to start. I developed some volatility-based strategies to more tune a trailing stop to the volatility of a specific stock. And I think that's really useful information too, just to understand that some stocks vary more than others, right? And that's a factor in your decision making. And ultimately, how do you put together a portfolio of assets that vary together, right, in a complementary way? And that's another thing that the public doesn't think about enough. So, yeah, this is simple, basic stuff that ultimately is about addressing human behavior. And unfortunately, a lot of institutions know more about us than we know about ourselves, and kind of lure us into reactive decision making instead of proactive decision making based on real knowledge and real confidence.
Where can people learn more about your work and this volatility component to trailing stops?
drrichardsmith.com, drrichardsmith.com.
Wow, this was fun, and we got to some pure gold at the end. So thank you, Dr. Richard Smith. And this was fun. We'll have to have you on back soon about, we had a trailing stops hour with you years ago. I want to have that again. That was a lot of fun. So
Great.
Folks,
well, thanks for having me, Josh.
Give us a call. Thank you for joining us. drrichardsmith.com. Is it drrichardsmith.com or drrichardsmith.com?
drrichardsmith.com.
drrichardsmith.com. This is Josh Jalinski, the financial quarterback, and we're taking your calls all hour at 800-321-0710 when we return. Call us at 888-988-JOSH.
The preceding program was sponsored by the Jalinski Advisory Group. Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to affect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.